Guys, I'm not going to lie. I'm a little bit nervous right now with what's going on in the market. Now, you are familiar with this channel. You know I'm not the perma bear. I'm the one that led you to buy the SPY at 410. Go back and watch that video if you don't believe me from September 2023. We bought heavily the SPY at 410. We got in on IWM. We got in on TLT. We got in early on all of these things. This same guy is telling you that now my antennas are tuned to what is currently happening. If you watch my last couple of videos, you'll know it's not just because we are at all-time highs. That is stupid. I don't engage in this gambler's fallacy type of mentality, which to me is a misconception anyway. There's plenty of times that we made all-time highs without tanking. It is what is going on around the narrative of these all-time highs. Remember that we are at peak rates. So when the S&P 500, when the stock market in general makes all-time highs at peak rates right before the Fed is expected to cut a few months before, and you have phenomena such as the yield curve uninverting, this is almost the flattest yield curve that we've had in almost 2 years. And then you look at what's going on with regards to corporate jobs and with regards to actual employment. We see that Google's laying off employees, Amazon's laying off employees. Just today, as of the time of this recording, U.S. initial jobless claims came in super hot. 214,000 versus 200,000 expected. Now, the single reading is not enough to be a cause for concern. I'm talking about the entire narrative. Now, I haven't even gotten to the juicy part yet. What is going on with mega cap earnings? We had the first of the Mag 7, the first casualty of the Mag 7 being Tesla. Tesla down 12% right after reporting earnings. Now, it wasn't really the earnings. It was what they said about the future and what their guidance was that really caused investors to spook. Also, right before I started recording, you have Intel sinking after beating on earnings and beating on revenue. It's not sinking because of what it did. It's sinking because of the outlook. Remember that the stock market is forward looking. And when there is a narrative that there's a potential recession on the horizon, what you don't want to see is companies coming out and saying, guys, I know that you expected us to report 33 cents a share next quarter and 14.15 billion in revenue. We're actually only going to do 13 cents per share and 12.2 to 13.2 billion in sales for next quarter. Sorry to disappoint you, but things are looking grim for us. Tesla coming out saying that its growth is going to be substantially below 2023's level in 2024. This is why I said in my last couple of videos and why in the Discord I was saying that I'm going to start selling calls against some of my shares. We took an epic short on the NASDAQ. Obviously, when we're day trading, we don't care whether we're going long or short. But the point is, we are not just sitting on our hands waiting for the market to somehow correct itself. I'm actively looking at what's going on in the market. I actively buy the dip, buy the crash when I think it is the right time. I actively sell calls against my shares or sell my riskier stocks when I think it's time. And then obviously we have the tool of day trading every day, which is basically learning how to fish, which is amazing because you can wake up without any bias and then formulate your bias and trade that. So make sure that you are joining us in the Discord if you want access to all of my outlooks, all of my daily plays, all of my long-term plays, my option sells, etc. We are closing January 31st. Use the link in the description to get your discount for life. And let's get right back to the video. So as I was saying, we are hitting all-time highs, or we hit all-time highs when we are basically seeing all of the markers of a recession popping up around us. Now, what's crazy is that the initial GDP reading today came out much higher than expected. But what we know about the GDP readings is that the initial reading is always revised. So we came in at 3.3%. This is for Q4 2023. But me personally, I don't care what has already been reported. For me, when I take a look at what Tesla is saying, when I take a look at what Intel is saying, to me, these are precursors and sort of like danger flares telling us that, hey, these mega cap earnings, man, they're telling us that they are not enthusiastic about 2024. So when I take that in conjunction with the yield curve almost uninverting between the 10 and the 2, when you look at the 10-year minus 3-month yield curve, which is another recession indicator that we use, this is the longest since 1965 to 1967. 457 days. This is even more than the double dip recession that I talked about in my last video. the one from 1980, 1981, one of the reasons that I said we could have a double dip recession here, even though we had one in 2020, we could have one in 2024, which is not that far away from 2020. We saw a very similar thing in the 80s. And I compared the fact that we were at peak rates at all-time highs during this double dip recession where we were fighting inflation as well. But this type of lengthy inversion is something that once it resolves always leads us to a recession. It is never given a false indicator. So if we look at the Bureau of Economic Analysis, what they call the LEI, which is the leading economic indicator, you can Google about that and read how they come up with it. But basically, they are expecting Q2 and Q3 of this year to be negative. Now, they did project that we would get a recession in 2023. As I've stated many times on this channel, it is impossible. I don't care who you are. It is impossible to determine when a recession is going to hit us and what is actually going to be the extent of the recession, not only the length of the recession itself, but the length of the bear market it causes. Remember, we've never had a recession without a bear market. We have had bear markets without recessions, but I've showed this in my last video, so I don't want to spend too much time on it. You can see that there is very little correlation between the length of a recession and the length of a bear market. Here we had an 8-month recession and a 31-month bear market. Right before that, we've had an 18-month recession and only a 17-month bear market. So there is very little correlation between the two. I don't try to predict. I've never told you that, for certain we are going to get a recession and this is how bad it's going to be. And this is what the bear market is going to look like accompanying that recession. So I'm not even going to start now. What I am going to tell you once again is that this is a period of caution. This is not a buy the everything dip situation, right? Buy the dip on everything situation. There are certain things like I will start to nibble on Tesla once again after a week or so dies down. You can see here, we had a very similar move in Tesla after earnings. It tanked. It took a week to bottom out. Same thing back in October 2023. It tanked, took about a week to bottom out. So I want to see what it does here. I'm not saying it will bottom out in a week, even though I've stated this before. And I've mentioned it on my Twitter. By the way, I release free daily trading and finance content on both Twitter and Instagram. So it behooves you to actually follow me on both Twitter and Instagram because I do daily trading and finance content. But what I was saying was 6 weeks in a row of negative, that's only happened 3 times in history on Tesla. And every single time it's been followed by violent rallies. So I'm not saying that that is the case here. I do think we will have 6 negative weeks. I'm saying that I would rather wait a week and see what happens here as opposed to just try to jump in and buy the dip. Same thing with Intel, same thing with other stocks that might fall here. To me, this is not a buy the dip on everything situation. I did my job. I bought when everybody else was fearful. And now I'm just going to be making a determination with how many calls to sell against my shares, how many shares to take profit on, whether I hold or not. I got in so cheap on so many of these things. Again, if you weren't part of the academy, you likely missed out on all these opportunistic buys. To me, it is the best value if you are going to join a group of traders/investors who are like-minded and share ideas with each other. But I personally don't think this is actually the time to buy here, in my opinion. I do think that, on corrections, fine, it's fine to dollar cost average, but I personally don't think it is the time to buy heavy here. As I said in my previous video, I will be nibbling on certain things. Like I definitely will be nibbling on Tesla. I am going to wait about a week or so, but I will be nibbling on Tesla here. I am going to be adding more to my bond positions at some point as the yield curve uninverts, as bond yields start to drop when the Fed finally decides to cut, which I think they will do around May. Now, I'm not saying that this is the absolute top. I can see the SPY continue to inch higher. As I've said, I've studied how the markets perform at all-time highs right before recession. And certainly even in 2007, you can see the market inching up higher and higher and higher. So I wouldn't put it past the market to continue inching up. We can even get to 500 on the SPY, guys. Like that's not out of the realm of possibility. But as I said before, I am very careful with what I do here because this type of environment is not conducive to going heavy in stocks. The time to go heavy is not now. If you missed it, you missed it. You are going to have to wait for the next opportune time, in my opinion. The only index that I like here in terms of what I think is investment worthy in the midterm is the Russell 2000, right? If we are going to get a rally until a recession actually rears its head, and remember, they were wrong about a recession projection before. They said 2023, now it's 2024. It could be end of 2024. It could even be 2025. That's how recessions work. I happen to think it's this year, but that's neither here nor there. Until that point, whether it's May or June or July or December, if we are going to rally, I think that IWM will catch up to the SPY in terms of nearing its all-time highs before we do get a recession. Unless something pops off in terms of like a black swan, pops off a lot earlier, then I think there's going to be no mercy on anything. And lastly, I do think the Fed is going to skip in January. I don't think anyone in their right mind thinks that they're going to hike. March still seems like a mixed bag. 50% of the people think they'll cut. 50% of the people think that they're going to stay. As of now, I personally think they are going to stay. In May, I think they are probably likely going to cut, in my opinion, especially if more of this BS starts happening with regards to guidance. Obviously, we have Apple, Microsoft, etc. So they can keep the party going for a little bit, or if all of them say, guys, we are on the same page as Intel and Tesla, our guidance looks shit too, that will be it for that will be when it starts to unravel. If they say our guidance is actually better than expected or similar to what we expected, the party will keep going for a little bit longer. Let me know in the comment section what you guys think. Are you buying anything here? Are you waiting in cash? Did you buy and then finally sell now? Are you looking to buy here? I would love to hear from you if you are, especially you guys, the ones that are saying, no, I want to buy here. I would love to hear from you. Again, closing on January 31st to the public. If you want to get in, you better get in. Otherwise, it's going to be invite/application only. We are looking to keep it an exclusive, tight-knit, private group. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.